Welcome to episode 7 of the More Doors podcast. I am your fill-in main DJ, Brian Force, here with Mr. Matt Pachowski, and we are going to get started with a very special guest right now. Welcome back to the More Doors podcast. I am Brian Force, very excited about today's guest, but first, I want to make sure that we plug all the sponsors and cool people that make this stuff happen, starting with Deep Blue Capital. Make sure you go check out deepbluere.com. If you're looking to start or continue or grow your portfolio, you want to build legacy wealth and enhance your investment career, go check out what we're doing at Deep Blue Capital. That's deepbluere.com. And when you're done with that and you're ready to start your own podcast, go check out Tor Studios. That's where we're sitting right now, TORE studios.com, and come and get your media on. Today, we've got an incredible guest. I'm going to turn it over to Matt to do a whole bio intro. I'm really pumped about this one. Matt, turn it over to you, my friend. How are you?
What's up, bro?
Hey. Man,
it's another glorious Thursday.
We got the lights down really low today.
Isn't it?
Because I'm sitting on this side of the table, so we got to black it out.
Nice.
You look very sensual.
I look
right now.
very red. I don't know why. I'm definitely not this sunburned. I don't know what's going on.
I'm liking
Jesse
this.
may have put the wrong color light bulbs in there or something.
Right? I'm liking this whole get up. I like. Did you
You
tailor
like
that yourself?
No.
Did you know that's my dirty little secret? I tailor my own clothes.
That's weird.
It's like a meditation, dude. It's like cooking. It's
Really?
very peaceful.
All right. I want to see your sewing machine next time I'm over there.
100%, dude. It's in my office.
Really?
I'm totally not kidding.
Okay. Is it right next to the phonograph that you play your records on?
Exactly. Right. Oh, man.
All right. So, team, everybody, very excited today. We have Sam Silverman with us as our special guest today. Sam's headline on social media, I think LinkedIn, is former sales leader retired by 28 through passive investing. And to me, that is one hell of an amazing tagline. Sam's a former technology salesperson and sales leader who was able to get off the golden handcuffs, if you will, by the age of 28. Yeah, 28.
Damn.
And is now into full-time real estate investing. He started his tech career as an SDR. And for those that don't know, that's fancy for a low-paid, high-ambition cold caller.
There you go.
Calling into businesses to get meetings and building pipeline. He moved into SDR leadership role and then became a VP of sales at another tech company. Right around that time, coincidentally, Sam became an executive member of the Revenue Collective in a passive investment capital group and started Silverman Capital, his own venture, that co-GP'd and LP'd into 21 projects totaling over 4,000 units.
Wow.
In 2023, Sam joined TechVestor, an investment company focused on premier short-term rentals. You got to check these things out.
Yeah.
They are sweet.
Yeah.
And that fund operates across the U.S. that has raised over $100 million. And Sam recently started Fully Funded, a capital-raising community helping others follow in his own footsteps. So super excited to have Sam on. I think up until this point in our podcast, we had really focused just on multifamily. Mm-hmm. And one of the things I'm super impressed about with Sam is, he started out in multifamily and found other opportunities to raise capital for and make money for his investors. So, Sam, we're really excited. Thanks for finding time out of your busy schedule to join us.
Yeah, of course. No, definitely happy to be here.
Where are you calling in from today?
So I am down in Tampa, Florida, but originally from Brooklyn, New York. So went to school down here and have not left yet.
Brooklyn. What part of Brooklyn?
So Flatbush and then Park Slope.
Nice. Now, Biggie was Bed-Stuy, not Flatbush, right?
Mm-hmm.
Correct.
Okay.
Correct. Bed-Stuy is nice now. So if you look at like the Bed-Stuy used to be an area where you wouldn't want to go outside. And now you've got brownstones there for $2-3 million.
Yeah.
Wow.
It's a lot like Dumbo, where you used to be able to get a building for free because they were all abandoned, and now you got to have $5 million just to get in.
I used to go to some.
Yeah,
sick
Dumbo's
raves in
got
Dumbo.
they've got the really cool like waterfront properties too, like all the old industrial loft type properties.
Oh yeah.
Those are doing. Yeah, that area has changed dramatically.
nuts, dude. That's
Nice.
awesome.
Awesome. So before the show, we were rapping a little bit about where you're off to next. Give all our listeners a little idea as to what it's like to shake off the golden handcuffs and be able to travel around the world. Where are you off to next?
So I'm actually heading up to New York for a few days to go see my mom. She's still actually in Brooklyn herself. She's a local realtor there too. So I hear all about the stuff going on there, and then off to Europe for a little bit. Go bounce around there for a bit.
Outstanding. Well, Sam, really excited to have you. I'm really, I've been anxious to have you on the show. You and I spoke, I think, for the first time a couple years ago. You've looked at a couple of our opportunities. I've been following you closely on all the socials, and just an incredible story. I'd really like to paint the picture for our listeners about what it's like to start off in tech and grow your skill set and move into real estate full time. But so let's kind of start at the beginning. At the onset of your career, why did you choose to start on the technology sales space?
If I told you I chose to start there, I'd be entirely lying to you. It was more of by accident, right? Applied on a job board out of school, didn't know what I wanted to do. Ended up at a tech company, a super small startup, which is actually a great experience, right? One, actually made a lot of good friends at that company, right? It was super small, 30, 40 employees. Really great experience too, because you got direct access to the CEO, who was a big serial entrepreneur. Him and I are still close friends. I've worked for him now 3 times over a 6-year period. Kind of followed him around company to company. But I think the SDR world is a great place to go start, right? In the sense of your sole job is find executives in certain accounts or types of companies, get in front of them, book meetings, right? That skill is entirely transferable to almost every aspect of life, right? Getting conversations and getting the attention of people in high value roles or can make large decisions. So that was a really cool experience. From there, actually built out the SDR organization at a company called LivePerson. I built it from 0 to about 120 people globally over a 2-year period. The stock price there reflects that. If you look at it from mid 2018 to end of 2020, anything going on now I can't speak for. Kind of from there, followed the old boss as well to a new company called Prometric. So they're actually really interesting too, kind of learning a lot about the education space, right, and kind of how things are shifting going forward. But yeah, that's kind of the professional side of it, and then kind of looking at the real estate side of it. Started in single family houses actually when I was still an SDR there. And your comment earlier about being low paid is actually not overly true. Right? I think I was making about $250,000 as an SDR for about a year period at my second company. If you're good at anything in a certain field, people will pay you a large amount of money to go do so. Sure. So all those people who are listening who are in certain fields may not be that high paid, be the best person in that field, you'll get paid for doing so. Yep. Right? So started buying single family houses, right? Realized it was just not something I wanted to go do long term in terms of the level of effort needed for each transaction. It wasn't scalable enough, right? Like the big realization I had was that my time was better spent and allocated towards really performing in my sales jobs, right? And sales is a field where if you perform well, you make 3, 4, 5x they say you should make. If not, you can make yourself, half what you should make and be on a quick path to getting fired. So for me, I kind of took the step back and realized, okay, my time is just better spent working in the day job versus doing these smaller transactions that had way too much effort in them and time and headspace needed versus the output that I was getting from them. So
if I'm thinking about what you just said, right, by focusing on your day job, you were able to make more money, right, and ultimately plan to scale rather than just get the cash flow on onesie twosies single family properties.
Correct.
Got it.
Yeah,
okay.
So I eventually sold, all those properties to Zillow back when they were still buying homes. So, really nice transactions there. And kind of from there, started investing really aggressively as an LP into projects, right? Multifamily, mobile home parks, storage, short-term rentals, debt, right? Basically anything that, looked interesting. Being your own money, you can be a lot more free-willed where you place it, right? Yeah. In terms of, if I lose 50 grand, that's it, I lose 50 grand. If I lose 50 grand investors capital, it's a lot more than 50 grand, right? Sure. In terms of overall reputational experience, future referrals, etc. So kind of, started investing aggressively as an LP. I think I was in 15, 16 deals prior to really going active, right? Because if you look at it, there's kind of 2 main things that matter, right? Kind of one is you find a deal and 2 is you find money. And for me, kind of the background I had really tied to finding people who would be potential investors. And the storyline made a ton of sense. So really dove deep there. Once kind of realized now's the path I wanted to go.
So how did you change your mindset, or what was the catalyst for you to go from single family into larger investments, multifamily storage, etc.?
So I'm a really big believer on going as niche as possible into something, right? Like the jack of all trades, master of none is really worth very little when looking at values versus someone who's very, very, very good at one specific area. So for me, what I found is that that one area that I could really excel in is skills I already had from my previous career, right? In terms of getting in front of the right people, having conversations, transferring value, right? Understanding kind of motivations and alignment there. And the storyline was really solid, right? So for me, I was really someone who was my ideal profile of investor. So when you look at sales, the better you understand your buyer, right? Investor, buyer can be kind of used interchangeably here. The better off you'll be in positioning what you're doing to relate to what they want. So for me, I was the exact profile of person that I was targeting as, building out my investor list. So really just dove deep in there, and it made more sense. I can go focus on one key area, go very, very deep, go find core operating partners in certain asset classes, and go partner with people who are already doing things really well, versus trying to go learn an entirely new craft that, didn't make sense to me to go spend time into, right? So then you have a lot more agility with your business as well, right? Instead of being branded the multifamily guy, you're another person who finds good partners, vets good quality groups, right? Puts your own capital there first, and then brings those opportunities to your partners versus being someone who has to go so deep into one key area.
Gotcha. So you mentioned before that you went into like 15 or 16 LP investments. So you're fully employed, W-2 employee, but you're using your income to make investments into some of these other projects while you learn who the key operators and the niches that you wanted to invest in. Did I understand that right?
Yeah. So if you look at kind of the path I took there, right? Today all I invest in still is LP deals. I'm in 52, 53 projects right now, I believe. Various cycles between, just wrote a check, exited, active, etc. But, it's all I invest into. I don't have a dollar in the stock market. So kind of I realized that route it was a very highly paid education course, right? Especially when I was doing it, starting in kind of early 2019, right? When you could have thrown, and offered anything and it made money in that period of time.
Yep.
So it's been a good time to get involved, which helped free up a lot of future cash as well for future projects.
Gotcha. So what was so you're investing, it sounds like you're building up your network of operators and GPs and deal sponsors. You're putting your own money into deals. How did you figure out, or how did you end up diversifying into raising capital from your network?
So a lot of it kind of stemmed from people would ask me really frequently, what are you investing in? Right? Like it's a really common type conversation when you see, someone doing a lot of research on the topic, right? Really diving deep into it. People would start asking, how do we get involved in deals like this? If you ever do stuff on your own, let us know. And it was more so at first, I kind of blew everyone off and just kind of kept doing my own thing, and just realizing it's, something that I thought I'd work for a lot longer in tech and just keep funneling the cash I had into those projects, right? Because passive income, you get it one of two ways typically. Right. One way is through sweat equity, right? Putting in, labor, time, et cetera, into projects that in turn will pay you in the future. Right. Or the second way is kind of the way I went, was you buy it, right? You really trade your active income that you earn into projects for future passive income. Right. So for me, like that storyline was so compelling to go work with operating partners I, met, vetted, kind of worked with thoroughly beforehand. Right. And they kept bringing it up as like, hey, you should go. If you're ever interested, we're always looking at kind of bringing on a partner or two to help us in the capital side of the house. And that storyline you can go tell is really compelling already, being that you're already in deals like this, right? Mm-hmm. So it helps in terms of the message you're portraying. There are a lot of investor calls that I have had and will have where people are like, okay, how much money of yours do you have in this project? Great, we'll match it. Great, we'll do this amount, right? So the confidence of your money there first helps speak volumes both to good operating partners and also to investors.
Yeah. We found the same thing. I know you have a lot of insight on that. But
I mean, I can't really stress that point enough, right? As far as actionable advice goes, I know a lot of people that listen to these types of shows and podcasts and things like that, their main question is, where do I start, right? And I don't have the connections, or I don't know how to, make or build the relationships or whatever. so much of your story is going to begin with you taking the leap, especially on LP deals, right? Our last GP deal that we just closed, we had a laundry list of people, at least on my end, that had never done an LP deal before and weren't able to get in on this one. But now their reticular activators are up, and ever since we've closed that deal, it's always you go to a birthday party and those people there. When are you guys doing another deal? Yeah. How can I get in on it, right? Like you start building that network. You don't have to necessarily go, I'm going to go lead generate and pound the payment every single day. You get involved yourself, and your story becomes the thing that expands your relationships and expands your network. Getting that hands-on experience is invaluable. So I would say if you're looking to invest, obviously, but if you're looking to become a syndicator at some point, you better be an LP first for a lot of reasons, but more so than anything, that's where the story begins for most people, and that's where you really cut your teeth and start building those relationships.
Yeah, I agree with that. I mean, I don't know if I necessarily 100% agree with being the LP first, but I definitely think that having your own money into projects before and the project that you're going to market with are really key. I know a lot of people. Go ahead, Sam.
Yeah, I was saying, so in smaller groups, sure, right? If you're kind of doing a few deals here and there. For larger companies, I care much less about how much money they have into the deal themselves. And I'll tell you why, right? The bigger thing I care about is what's the overall skin in the game they have. And that's not just cash. Taking, for example, that I used earlier, if I put 50 grand into a deal myself, just as an LP and I lose it, I lose 50 grand. That's the extent of that. If someone has cash into a deal and they lose that, that's the extent of it. What matters more to me is reputational risk of a group, right? By acting unethically, right? Not being transparent, right? Not performing, doing what they say they were going to do. That matters actually far more to me than how much cash they have in the deal themselves. Because if they're doing a volume of deals, right? Not, 1-2 deals a year. If they're doing 5, 10, 15 projects per year, right? You still have millions of dollars at one time tied up in earnest money in projects, right? I'd rather see them be in a place of financial stability, right? Personally, right, and have reputational risk on the line in their company versus having a ton of cash into the deal themselves.
The reputational risk, to your point, is exponentially more important.
Correct.
Right? I mean, it's very difficult to go out and raise money on subsequent deals if you fail to execute on any of them.
I'd say reputation is the ultimate skin in the game.
Absolutely. Absolutely. All right, Sam. So you invest in a bunch of LP deals. You're using your income from the W-2 to fund these LPs. You're starting to build your network of operators that you go back to, and they start encouraging you to come into deals as in more of what it sounds like a capital raising type function. And then it looks like you take another leap and join TechVestor. So why don't you tell us a little bit about what TechVestor is and how'd you get connected to them?
Yeah, so actually I connected them early last year through a friend who's a part of a venture capital fund. And what they look to do is go invest into kind of early stage tech companies to help them scale, right, on kind of the go-to-market side of the house. So for they had the conversation. The big thing about TechVestor as well is they started as a tech company, right, in terms of building technology that allows you to go underwrite properties at scale to really find which the best markets, best properties in those markets to go run in short-term rentals, right? So basically built an acquisition engine that helped you scale in a space that finding deals is very difficult in, especially the last few years. So at that conversation, really realized that all the tech they have is all meant to be used internally versus actually making it a public offering. So they'd raised around the money, kind of tap their friends and family side of it. Like, we need someone to come help on the capital market side of the house and can kind of really help scale the capital side for us as we have significant deal flow, great operations already, right? So for me, kind of joined them early last year, help build out their kind of fund to fund program, right? We raise all of our capital both from retail investors and fund managers, right? So for us, vertically integrated, we do everything ourselves in terms of acquisitions, financing, the debt side of it, construction management, design, property management, right? So we have control over every area of the whole process looking at the STR space, right? We're really bullish in the space as a whole from the stance of we believe single family homes are a mispriced asset class, right? Because currently the bulk of them trade on comparison value. Like if you or myself are going to go buy a house for our family, right? You go in there, what's the square footage? What's the zip code, right? What are the finishes? Well, most other asset classes in real estate trade based on the cap rate, which is a multiple of their net operating income. So our big belief there is that single family homes were mispriced asset class because they will start trading on the cap rate in the future. We've already seen it selling off a handful of properties in our first fund because of that. right? So we're now in our second fund. We probably raised $60-ish million in total between the two funds. We're closing in at $100 million of assets there. But it's a great play in terms of we feel as though we're early still, right? So if you look at institutions, they can go buy an apartment complex for $100 million tomorrow and place $50 million equity into that complex. When you look at the STR space, it's primarily single family homes, right? Meaning that you have to go find each property, get debt in each property, do construction in each property, design each property, manage each property. So that lift requires a full operational company, right? So for us, we have the infrastructure in place where institutions, they can't build it, they'd rather go buy it. So for us, we feel as though we have a good edge being the company that sells our full portfolio to institutions looking to go have scale in it, in terms of a roll-up play.
Wow, I love that.
Yeah, 100%. What is so? I want to understand a little bit more about that investment thesis, right? Because obviously, from a short-term rental perspective, valuing an asset based off of your cap rate is wildly more appropriate than a comparison value because it's two different uses. One is actually a business, one is a single-family home. Mm-hmm. Do you believe is there a limitation to the upside to that, Sam? Eventually, meaning, you still have people living in homesteads, right? So at what point does it make sense for the entire asset class of single families to be valued off of cap rate rather than comparisons if you still have 100 million households in America living in homesteads? Like, could you take just a slightly deeper dive into that investment thesis?
So if you look at what we're actually selling in the future, we actually exit properties, you're selling a stabilized business, right? So the property itself is already up and running. So I think if you're buying a single family property today, it's like you can trade on comparison value. But if you're buying a property that's fully built out as an STR with multiple years of history of performance and systems in place to go take that over really efficiently, it's going to trade on a cap rate, right? So for us, we're getting ourselves in a position where we have everything in place in terms of management, operations, right? All those things, and the biggest thing too is length of performance in terms of historicals. For multifamily, you may need a T3 to go trade, right? What I think we'll see here is that a T24, T36 will be very, very valuable. And what I mean by that is that longer history of performance will come into play much more so versus short windows of kind of more fixed rate income. So for us, we see that as a big opportunity to really go drill down on the management, drill down on our OpEx going forward.
Yeah,
nice.
Makes perfect sense. I mean, it does, and it's an interesting concept because it is. We talk about the American dream of home ownership and that being a primary wealth building tool, and the assets are valued completely different than every other real estate wealth building tool out there. It doesn't the fact that we only value single family assets off of comparison value, I think, has been a big gap in that particular class for a long time. So it's an interesting theory. I like it.
Yeah, I think the other point of view though is, and we're starting to see some of these single family deals being sold at STR prices based on this kind of math.
Yes.
Right. And how much of a squeeze does that put on, Jimmy and Susie first time home buyer, right? And
does it do that, or does it make the asset prices that much more volatile?
Yeah.
Right.
I think time will tell on that.
Yeah.
Curious, Sam, when you're so there's so much to unpack with what you just said. I guess the first thing I'm thinking about is, how does the platform find assets? Is it just scanning the entire map of the U.S., or do you have some hotspots that you've picked out?
So I think we track and monitor roughly 260 markets today, right? We track things based on the keywords in terms of revenue performance. We're tied to tools like AirDNA that has custom pricing built for us in terms of our model, right? Scott Schaffer, the founder, and Jamie Linson are board today. Right, so we're very in depth in terms of custom tools for pricing, right, to actually go figure out the performance of assets going forward. But at a super high level, it allows us to go narrow down markets that we track that have enough supply and demand, right? Because say certain markets only need a 4, 5, or 6 bedroom house, right? We don't care what the overall supply is there. It's not supply in that specific type of asset that we need, right? So we're tracking, the lot sizes that we need. We're tracking the keywords that we need, right? Certain keywords produce more in Airbnb in terms of performance, right? Like all those things we've kind of come into fact with us based on our total cost outlay for each asset and based on roughly the cash on cash. So if you look at it at a super high level, it allows us to go pick those top 1-2% of properties on the market and then have our team go hand underwrite them. Think of what Zillow did with kind of the iHome buyer program, but they were using it to make full offers. we're using it to make our acquisitions team much more efficient. We have a head of data science as well, is very known in the industry as well as the Airbnb data guy, right? So for us, we have a full deal review committee twice a week that dives deep into those properties that make the most sense after the kind of automated test, the eye test, and actually hand underwriting test as well. So it allows our people to be much more efficient and kind of pinpoint properties that make sense to spend time into versus scanning everything possible and having to, that be a much bigger bottleneck than it is today.
Yeah. When you talk about, really quickly, you mentioned this a couple times there, you talk about keyword analysis and things like that. You're talking about like the optimization of the actual descriptions and things like that, like what types of properties people are looking for, like, and you're taking that into consideration in your investment criteria is the actual
Correct.
like key. Wow, that's an interesting
Yeah,
approach
so
for
things
short-term rentals.
Well, things if you look at it too, down to the science of, what spacing do we have outside? How many square feet are in a certain area? How big are the rooms, right? All these things in terms of different pieces of data that we can go take in help us make decisions much more quickly, much more efficiently.
Wow.
So after all this scanning and you find deals that you want to pursue, like what type of target returns are you looking at as you start to pursue properties?
Our biggest thing we look at is seeing a 10% cash on cash or higher asset level.
And that's accrued or instant, after ramp up?
Once stabilized.
Wow.
Yeah.
Once stabilized, on average too, if you kind of look at it, we're roughly 6 to 8 weeks from property closing to property live. But then you have roughly, a year of stabilization just because some properties are seasonal, right? Like for example, take some markets may be really strong in the summer and very weak in the winter, right? So our goal there is to have at least 2.5 positive seasons in each property and have a limit downside in terms of expenses in down seasons.
That's awesome.
Wow.
That's great.
And also the nice thing too is that we're nationwide as well. So the cash flow for your portfolio doesn't really ebb and flow as much as you'd think because certain assets we have or certain markets we're in are very strong in the summer. Certain markets are very strong in the winter, right? So for us, it's very diversified. So ideally your cash flow level is at once stabilized.
Yeah, I mean, that's a huge competitive advantage, right? I mean, Miami's always going to offset Vail, Colorado, right? So if you diversify enough, then that's how you stabilize the cash flow. That's in depth, man, as far as building a short-term rental fund. I mean, you're competing against the mom and pops who are just trying to, I have 2 of them, right? And honestly, they drive me crazy. I wish I could do it at scale.
I can give you, I have 2 myself that I owned prior to coming on board at TechVestor. But one was the personal house then in Tampa that I built and, wanted to move out of it, downsize to an apartment, be kind of closer downtown. And the second was actually a place in Scottsdale where we have a pretty big holdings as well. And if you look at kind of the house I have in Scottsdale, it'll do like 110, 115 a year, right? It's basically me and a friend impulse bought it, threw furniture into it, thought it'd be a fun project to go do.
Sure.
And that probably do like 110, 115. We have similar properties in the fund that'll do 170 to 180.
Wow.
Right. So that spread in terms of performance is huge.
Oh my gosh. And you get a 3-5 year time horizon too. I mean, that's exponential.
Yeah.
That's
correct. Especially looking at the exit of it too, right? If you do, $70,000 more in revenue, even at a half expense margin, $35,000 in NOI, right, is worth quite a bit.
Yeah, call it a 5 cap, and I mean that's a
not a 5 cap, not a 5 cap, but I'd say call it. We model a 7.5 on exit.
Okay.
Really?
I think we'll see lower than that. We model a 7.5 on our portfolio on exit. We sold off 8 assets in fund 1 between a 5.5 and a 6.5 cap, single assets. Right. Our view as well is the more consolidation you have of properties, the lower the cap rate in which you'll get, right, for the roll-up play in terms of economies of scale. But yeah, even at a 7.5, it's still $500,000 right of value, $450 of value, right? So really strong in that sense.
So are you seeing the cap rates? Are you using cap rates on valuing these assets in alignment with multifamily assets in the same MSAs, or are they different?
So we more just give ourselves a lot of buffer room when looking at the actual exits of them, right? We feel 7.5 is very conservative overall. When looking at their values versus multi-values, I think we'll always see more, higher caps in this space than multi, right? Especially in those markets. But yeah, we're not basing it off of it. But I think they definitely will be slightly higher than multi, just in terms of economies of scale of management.
Got it. I just had another question I forgot.
Really?
Brain fart time.
But I think a big thing too in this space that we can go dive into as well is the debt, right?
Yeah.
Like I think in, multi, you're seeing a lot of news stories, a lot of things going on. A lot of it's tied to debt that was floating rate,
Yep.
right? So if you look at what that means is that you typically have a curve and you're buying a spread above the curve. So if that curve goes up, right, whether it's, the treasury, LIBOR, so for
Right.
whatever it may be based off of, right, and your spread and that goes up, your rate goes up.
Yep.
People purchase rate caps, which used to be very, very cheap, now are very expensive because they know rates are rising, right? So what that means is that once that rate cap is hit for a period of time, the rate will remain at that rate and can't go higher.
Right.
But what you're seeing is that because debt service has gone up so much, the DSCR, the debt service coverage ratio, has gone down, right? And to go refinance a property, you typically want to see like a 1.25 or so DSCR for it, right? Meaning that you have to have $1.25 of net operating income for every dollar of debt that you have.
Yep.
With debt going up, right, and those rate caps expiring, two things happen. One, rate caps are much more expensive because of the uncertainty of where rates will go. Therefore, they have to price it higher. There may not be enough cash on hand to go support a new rate cap, meaning there could be a capital call needed. Second, if the DSCR is too low, it wouldn't qualify for a loan of certain leverage.
Right.
You have to bring more cash to the table to actually do a cash in refi versus a cash out refi. So those things can lead to either having for a capital call, distributions being cut, and or having to go short sell the asset just to go make sure you're not bleeding to a certain point in terms of getting new debt or getting a new loan. So for us, our biggest thing that we've seen is that in real estate, you typically get burned in two areas. One, if you buy wrong, right? Two, if you're a forced seller. In terms of being a forced seller, we really solve for that in the sense that all of our debt is fixed for at least 10 years. Most of our debt is fixed for at least 30, right? We've seen the spread in terms of the rates have gone much further down in 30-year P&I than 10 years IO. So for us, we take a tiny basis point hit on cash flow going to 30-year P&I, but we have 30 full years to exit the assets if we need to, right? Obviously, as sponsors, we make our money on the exits, right? But our number one goal is not losing investor capital. Yeah. So by not being forced sellers based on our debt terms, we can ride out any period of time that doesn't make sense to exit, right? In multi, you typically see a DSCR of like 1.25, give or take. Yeah. Our DSCR hovers at roughly 3x.
Wow.
Meaning we have 3 times the buffer room where things can go wrong, right? And we still will not have to do a capital call or cut distributions drastically.
Unbelievable. 3x DSCR, huh?
Yeah. I mean, you're not going to see that in multifamily.
Definitely not.
Often.
Definitely not.
No.
Do you feel pretty strong? I mean,
40
we've
years.
talked. Yeah, I mean, we've talked about that exact scenario, a bunch of times on this show and just in all of our, normal daily conversations, right? I think that you just described what is, a relatively grim potential outcome for some of the multifamily deals that are out there right now. That also creates a massive amount of opportunity. I know that you guys probably, you spend a ton of time and probably spend a fortune on analytics. Do you feel pretty strongly about that scenario coming true in the multifamily space over the next 24 months? Rate caps expiring, debt exploding, cap rates uncompressing, and the inability to refi creating a big issue. I think that's probably a foregone conclusion in some sense. But how serious of an issue do you think that is coming down the horizon?
I think it depends case to case, right? Like the way you go combat that is that you make sure that you're pushing rents enough and executing your renovation plan enough, right? Assuming it's a value multifamily type investment, right? Where you're forcing enough appreciation through increasing net operating income by raising rents, by making things more efficient to go combat any kind of decompression you may have, right? So if you're not able to go achieve those rents and keep occupancy and drive the NOI higher, you're in a bad spot. But if you're still executing your business plan, these deals may look more like they're supposed to, or there's a period of time where you're seeing deals exit in 12 months, hitting more than 5-year return profiles. So I think we'll see the people who can operate assets really well, right, survive. They may not be thriving as if they were, right, more of, walks and singles versus home runs.
Right.
And the people who were not able to go execute in terms of the actual managing the asset themselves, we'll see a lot more of strikeouts in terms of going forward, right? So I think you'll see how people actually operate the asset matters a lot more. Because before you used to be able to buy deals at a certain cap rate and sell it at a lower cap rate, right? Which means that you can make money by accident. I think now we'll really see people survive who operate assets really well, right? And can go increase their NOI enough to be in a position where they can go refinance regardless of what the rates, and leverage looks like.
Yeah, we've talked about that, right? Like the last couple of years, you didn't necessarily have to be good in multifamily. You just had to ride the tidal wave of cheap capital and compression and cap rate compression, and now you actually have to be good at it.
I think it goes back to 25 minutes ago we were talking about reputation being the ultimate skin in the game, right? There's going to be a make or break moment for a lot of operators out there in the next couple of years, and you lose some money of your own. That's some skin in the game. You lose your investors' money because you didn't execute your business plan. Well, that's going to create a lot of industry-wide scared money.
Yeah.
But the operators, the operators who stick to their plan and are able to still execute in a volatile, time and chapter, that's where that money is going to flow. It's going to get exponentially easier to raise capital for the people that are able to weather the storm, stick to their business plan, and come out on the other side, even if they're only hitting singles, because you're going to see a lot of deals that skin in the game. The money that the operators lose is nothing compared to the reputation and not doing a good deal.
Agreed. Agreed. Sam, you touched a lot on debt for the for this fund. Where are you guys getting your debt from?
So all of them are, as of right now, non-cross collateralized individual commercial loans that are structured based off DSCR.
Wow. So you're going to like local and regional banks and the MSAs that you operate in?
We have two primary national partners that we can see leverage and kind of bid out rates all the time, but we do probably some of the higher volume in this space. So we typically get preferential treatment both in terms of terms and price matching across the board.
Love it. Nice. Man, we have to make sure that the audience has access to TechVestor's portfolio. I see them on LinkedIn just about every day.
Yeah.
You have some gorgeous properties in the portfolio, Sam. Like, are you doing the design, or did you hire someone away from like the Barbie mansion in order to?
If I was doing design, If I was doing design, I'd be back in the corporate job pretty quickly. But no, we have full team of designers in house. Our partner Sabrina Guler leads the construction and design house of it. She's awesome. Team's great. Her and Josh lead that organization, and in terms of design and construction. But yeah, it makes a huge difference, right? Putting those dollars extra into making a unique experience, or providing quality amenities. Because if you look at the markets that we're in, right, we don't go compete with hotels, right, in terms of a 1-2 person stay typically.
Right.
The bulk of our stays are 6 people plus, right, where they want that common space. They want those amenities to go use. They want to be able to go make experience and memories with people they're going with. So for us, like, that's such a huge piece of it, is making those experiences memorable for them. So we're not competing with hotels in terms of those types of stays.
Gotcha.
Yeah.
Gotcha.
It's so key in the STR space too. Just again with actionable advice. I know short-term rental has been such a sexy investment tool for the last half decade and plus. And just like Sam was saying, this first one, you just thought it'd be a fun project, bought a house, threw some furniture in it. Like, unfortunately for some of the investors in the space, that kind of is the business plan. It's like, let's just buy a place and furnish it, right? But you're just not. Yeah. Okay.
Yeah, it used to be 2 dudes can go buy IKEA furniture and throw into a house, and you book up and hit Airbnb numbers. And I think what you're seeing now is that before, if you had 12 people looking at properties, 10 properties, every place gets booked up either in order of, best pricing or best design, best experience, right? Now you may have 8 people looking at 10 houses, right? 9 people looking at 10 houses instead. So there's those houses that offer that quality experience, because you look at what people do realistically, right? Like, say we're all going on a trip. One of us pulls up Airbnb, find the spot, send it to his, his or her 3, 4, 5, 6, 7, 8 friends. And they're like, okay, you guys can do this one of these 2, right? Go pick one. And it's really easy to go pick the ones that give that quality view and experience and have great pictures and have, quality reviews and all those things for it, right? It makes it a lot easier to go say yes.
Oh my gosh, 100%. On our property management side, we manage several that as well. And it's, you're always looking for, that arbitrage opportunity. Groupthink is going to take over pretty much any investment strategy. And if the investment strategy is go buy a house in a place that doesn't have enough short-term rentals yet, throw a bunch of furniture in there, and now you're going to be making money. Well, everybody's going to do that. And when everybody does it, now it doesn't work anymore. So what is the thing you can do to create that arbitrage? What is the experience that you can now offer? And honestly, it's really not that difficult if you just think about the user experience. What do people want to do when they're away from home? It's also pretty common sense.
That's something we drill down to in a ton, is like, who's our actual profile of guest, like in each property that we do, and go tailor things for them, right? Like, we have properties that are full bachelorette themed. We have properties that are, summer getaway type themed, but like whatever it is, it matters much more so who that avatar of guest you have in mind and tailor things for them.
Yep.
Right. So I think that's a huge piece of it for us.
Yeah. 100%, man.
Nice.
Man.
You got to see these things. I'll send you a link, man.
I know, I haven't
As a
checked
matter
them
of
out
fact,
yet.
I think I saw a video on one of them on LinkedIn. It was a rehab project, and there was a bunch of guys in there with tech vest or shirts on, but I did not see Sam. So my guess is he's more
Yeah,
on
I
the
mean, again,
operations and
it's
cap
better
raising
for
side.
yeah, it's better for our liability that I'm not swinging a hammer anywhere. Um, but no, for us, we actually, all construction management's in-house, and actually all of our Florida properties, we do construction ourselves.
Really?
In terms of, so we have more and more control over every area of that process, right? In terms of cost, timelines, quality control, right? And actually just the expense side too. Because when you're outsourcing that side of it, they're really compensated based on completing projects, right? Their sole compensation is tied to the job itself. We know when it's in-house, the compensation is tied to the actual performance and overall structure of that deal itself.
Yep.
Right.
Gotcha.
So it helps give you more control and kind of levers that way.
So when you're doing your modeling, I don't want to be conscious of time here. I know you got to go in a few minutes, but when you're doing your modeling, like what kind of monthly occupancy do you expect out of one of these really cool properties?
So occupancy in this space is complete bullshit. Like
Really?
we can't evaluate things based on occupancy.
Okay.
Right. We can be occupied 100% if we price low enough to go do so.
Right.
Right. Our occupancy on average, I think we just had our first 80% month. If you look at your revenue, it's a component of, your occupancy is decimal and your ADR as a fixed number.
Yep.
Right. So when you look at that, we care about profitable bookings that have the highest level of revenue at the lowest cost to us.
Yep.
Right. We care about bottom line NOI. We don't care about occupancy. So not that we don't care about it, but we know it's only part of the equation.
Yeah,
And
as
looking
a
at that
function
piece
of
of
the
it.
yield curve, right? Because
Correct.
At a particular ADR, you can have whatever occupancy you want.
Correct. If we want to be 100% occupied, we can have the rooms at $99 a night and everyone lose money.
Yep.
Right. We have terrible quality guests. We lose money on them, and you just invite the wrong types of crowds there.
Yep.
So for us, we typically between low to mid 70s and then low 80s. I'd say probably 73 to 82 was kind of where we fluctuate on a month-to-month basis. But we also have ADRs in the 450 to 525 range per month as well across the full portfolio. So we're more concerned with total revenue versus occupancy in any given area. I think whenever someone's looking at an STR, make sure you're looking at kind of the total equation of both the occupancy as percentage and the ADR and how each one impacts the other one.
Yep.
And it's finding that sweet spot that allows you to go maximize revenue. Right. We have things built in terms of if someone checks in on this day, the stay to be at least this long. Right. Like in terms of, being very detailed in how we price as well. Right. In terms of supply and demand there, and also making sure we maximize certain days of the week too.
I love that because it's actually, what you're taking is a very nuanced and complex system of metrics and boiling them down to one KPI, which a lot of investors avoid doing. And that is, did you make fucking money?
Yeah,
right?
exactly.
Like we tend to get very into the sexiness of our different metrics and KPI, occupancy rates and all this type of stuff. And it's like, at the end of the day, what was your operating income?
Yeah.
Did you end up making
Right.
money? And so I think that's a very, very good, straightforward mentality to have.
Agreed.
Yeah. So,
Sam, there's a lot of people that are kind of tepid about the market right now. When we're out there raising capital, we're talking to certain investors or even LPs. They're waiting on the sidelines, right? The market's got them scared. What's your thesis on where we're at from a market cycle perspective, and is that impacting your acquisition strategy at all?
We're still heavily investing. I'm still personally heavily investing right now. My strategy is a bit different right now versus what it was in the past. Right now, more so, I want things to have longer term fixed rate debt, even understanding I'm giving up a little bit of upside potentially for doing so. Right. Say multifamily, if you take out a Fannie or Freddie loan on a 10-year term, right, you'll have penalties for exiting early. Right. So which means if the rates go down, you're taking a bath a little bit to go have that lower rate. Right. You have higher costs to go do so. Or if you have an opportunity to go sell it, your margins be cut a little bit by having those higher kind of prepayment penalties.
Yeah.
But you're also hedged in a way too that if the deal works those numbers debt wise, it works those numbers debt wise.
yeah. You're
Right. So for me, I'm okay leaving a little bit of upside on the table for more stability. Right. So everything I'm investing in now, we're fixed for at least 10 years in terms of debt. So while I give up some upside in doing so, my potential to go strike out goes down dramatically. Right. So it's making sure that these cap rates work in expanding market, right? In terms of the exit cap when looking at deals themselves, making sure there's actual, upside in the project itself, but also understanding too that I may be giving up some upside for a much higher floor, which to me, that trade-off is worth it all day long. It's very easy to come back from a walk than it is to come back from a complete miss from looking at investors' capital.
Yep.
Because all the money that I'm personally allocating are deals I bring investors to as well. So, I feel very confident in those projects. It just more so matters kind of what that person's horizon outlook looks like. But yeah, for me, if you have, if you're fixed for a period of time and have the ability to go write it out, and you're not banking on these crazy assumptions in terms of growth in certain areas, right? You'll be in a fine position overall.
Interesting. Yeah, agreed. Have you, just out of curiosity, have you tracked your ADR growth on the portfolio? Because I read a statistic just yesterday that rents on the multifamily side are down. I think Dallas was down 4% year over year. Some metros were higher. I think Austin and Houston kind of got their teeth kicked in a little bit.
Austin was down actually pretty significantly.
Yeah, but I've also seen Airbnb rates go down, either rates or occupancy. But it sounds like you guys have kind of the anomaly to that.
Give me 2 seconds. So it's also tougher to tell portfolio level wise, just because we have properties going live. Like we just finished getting every property live in Fund 1 this past couple weeks.
Yeah,
so if you look at it,
skewed,
right?
Yeah.
So like our snapshot data of just occupancy from January through June, our low was 74%, our high was 86% in June.
Wow.
With 5 months being between 74 and 78%. ADRs ranging from, on average per month, 406 on the low end to a high of 516. But 5 of the 6 came between 406 and 458. So, yeah. So, I mean, again, all of it really ties to what actually matters overall. Like, how does that look in terms of overall performance? And it's also data slightly skewed as well because we didn't have every property live in that period of time. So actually every property was live by July 1st. So for us, next July 1st, we'll have a full year of data that'll factor in seasonality.
Yeah.
So we have 2 things that skew the data a bit. One, every property wasn't live, and properties may have been live for a short period of time, either their peak season, which drove it up, their down season, which drove it down. Yeah. So for us, this time next year, we'll have a much better idea of what our stabilized ADR and occupancy are across the portfolio blended by seasonality.
Amazing. I love how quick he pulled up those metrics too. Right? That was fantastic. My goodness. I promise that wasn't teed up.
No, and I think knowing numbers is super helpful, right? In the sense of, we have probably the most institutional-like reporting for SDRs there is, right? Our head of portfolio management ran the fund division at Picasa, right? The largest operator in the space.
Wow. Yeah.
Not owner-operator, largest operator. So he's done a great job of building out really institutional and reporting for us, which to us on the exit, the more data we have around performance and why, and kind of those levers to pull as to actually how to change news versus just report on it, right, will help us in the exit quite a bit.
Yeah,
love it.
100%.
I want to come kind of wrap this up here, Sam, but I want to come full circle on something. There's a lot of folks out there, myself included, right? I've been in tech now for 13 years. It's a lot.
I know. It's old.
What advice would you give to salespeople, tech salespeople looking to amplify their earnings through real estate and potentially, shake off the golden handcuffs and become an entrepreneur?
Yeah, so I think there's a few things, right? One, like as simple as it sounds and as difficult as it may be, like making more money in your day job allows you to go move quicker when you figure out what you want to go do when you grow up, right? Like for me, for example, I didn't want to be in tech sales. So it wasn't like something I chose and set out to go be in. I ended up there, didn't know what I wanted to do long term, but I knew that I wanted to work for myself. So I'm like, okay, in the interim period, while I go figure this stuff out, I'll make as much money as I humanly can in these jobs that I'm doing, right? To go, once I figure it out, then I can go much more quickly to go do that, right? So I'd say it's, take some level of action, whether it's education in terms of, making yourself more money in your day job, education in terms of building a side hustle, investing passively. I also think the kind of sales profile is great when looking at the equity raising piece of the equation in the real estate space as well, right? Kind of go leveraging that network, leveraging your prospecting skills you've learned the entire time, being comfortable speaking about money. I think that's a great avenue as well.
Awesome.
Love that.
Great stuff. Brian, what else do you got for Sam before we got to let him go?
Oh, we got to let him go soon. Sam, where can people find you real quick so they can connect?
Yeah, so I'm super active on LinkedIn. And then also, if people are interested as well, I just started we're kind of in the process of launching a mastermind with all folks looking to go learn how to go raise private money. Great for people kind of in that tech sales space as well, kind of learn how to do so.
And that's fully funded, right?
Yep.
All right. Where can people go check that out?
So on our new LinkedIn page, we have our kind of new landing page up there as well, under fully funded.
Beautiful.
Love it.
Beautiful.
Love it.
This was great.
This was fantastic, man. We truly, truly appreciate the time. Everybody, make sure that you check out Fully Funded, check out Tech Investors, check out Sam on LinkedIn, and wherever you get your profiles, man. Thank you so much, Sam. This was wildly beneficial. It's been great talking to you, man. Congratulations on all the success, everything that you've accomplished, and we look forward to continue to follow your journey, man.
Cool. Yeah, thanks, guys.
Thank you, Sam. Appreciate you, brother. Good luck. Safe travels and enjoy yourself.
Yeah, thanks.
All right. Thank you.
All right. Check out Deep Blue RE, Tour Studios. Appreciate it, guys. We'll see you next time.
Thanks, everybody.